The Bank Realization Certificate (BRC) rules as per RBI. The Bank Realization Certificate (BRC) is governed by the Reserve Bank of India (RBI) under its foreign exchange regulations. The key rules and guidelines related to the issuance of BRCs, as stipulated by the RBI, are as follows. 1. Legal framework. Foreign Exchange Management Act, FEMA, 1999. BRCs are issued under the provisions of FEMA and its associated rules and regulations. The Act governs all transactions involving foreign exchange, including export proceeds. RBI guidelines. The RBI provides specific guidelines to banks on issuing BRCs to ensure compliance with FEMA and related laws. 2. Requirement for BRC. Export proceeds realization. A BRC is required to certify that the export proceeds, foreign currency earnings, have been realized by the exporter. This is a mandatory requirement for all exporters in India. Realization timeframe. As per RBI regulations, the export proceeds must be realized within the stipulated period, usually 9 months from the date of export. However, certain sectors, such as SEZs or specific export promotion schemes, may have different timelines. 3. Issuance of BRC by authorized dealer banks. BRCs are issued by banks authorized by the RBI to deal in foreign exchange, known as Authorized Dealer Category I banks. The exporter must submit the relevant export documentation, including the shipping bill and proof of inward remittance, to the bank to obtain the BRC. Electronic Bank Realization Certificate, e-BRC. The RBI, in coordination with the Directorate General of Foreign Trade, DGFT, has implemented an electronic system for issuing BRCs. The e-BRC is uploaded by the bank to the DGFT's server, and exporters can access it online. This system enhances transparency and reduces paperwork. 4. Use of BRC. Government incentives and benefits. The BRC is crucial for exporters to claim various export-related incentives and benefits, such as duty drawback, GST refunds, and benefits under export promotion schemes like maize merchandise exports from India scheme. Compliance with FEMA. The BRC is used to ensure that the export transaction complies with the requirements of FEMA, particularly concerning the realization and repatriation of export proceeds. 5. Penalties for non-compliance. Non-realization of export proceeds. If the export proceeds are not realized within the prescribed time, the exporter may face penalties under FEMA. The RBI may allow extensions in certain cases, but this must be applied for and justified by the exporter. Misrepresentation. Any misrepresentation or fraud in obtaining a BRC can lead to penalties under FEMA, including fines and possible prosecution. 6. Reporting to RBI. Export data reporting. Banks are required to report export data, including BRCs, to the RBI periodically. This helps the RBI monitor foreign exchange inflows and ensures that export transactions comply with national regulations. 7. Monitoring and audits. RBI and DGFT audits. The RBI and DGFT regularly audit banks and exporters to ensure compliance with BRC-related rules. Non-compliance may result in penalties or disqualification from receiving certain export incentives. Conclusion. The RBI's regulations on BRCs are designed to ensure that export proceeds are realized in a timely manner and are correctly reported to the authorities. Compliance with these rules is essential for exporters to benefit from government schemes and avoid penalties. The e-BRC system has streamlined the process, making it easier for both banks and exporters to manage BRCs.